Hello, my name is Alex Wynn, and currently I'm a sophomore finance student at Georgia Tech's Scheller College of Business. I'm interested in wealth management and investment strategy. Today I will be walking through my investment evaluation of Phillips 66, covering the company overview, Q4 2025 earning highlights, my financial model, and the rationale behind my projections of valuation. Starting with the company, Phillips 66 is a diversified energy, manufacturing, and logistics company headquartered in Houston, Texas. It was spun off from ConocoPhillips in 2012 and operates through four segments: refining, chemicals through its CP Chem joint venture with Chevron, midstream, and marketing and specialties. With refining capacity of approximately 1.9 million barrels per day, it's one of the largest independent downstream energy companies in the U.S. The stock currently trades at 155.75 a share with a market cap of roughly 71 billion. Now going to the key comments. Q4 2025 was a strong quarter. Revenue came in at approximately 38 billion, roughly flat year over year. Net income was 2.9 billion for the quarter with adjusted EPS of 2.47. Operating cash flow was 2.8 billion in Q4 and approximately 5 billion for the full year. The company returned 3.1 billion to shareholders in 2025 through dividends and buybacks, while keeping full-year capex disciplined at 2.2 billion. Debt was reduced by approximately 2 billion in Q4 alone, meaningfully strengthening the balance sheet. On the segment side, refining had a standout quarter, approximately 99% utilization with record product yields. Midstream hit record NGL volumes of over 1 million barrels per day, driven by infrastructure expansions. Chemicals and marketing were more mixed, pressured by margins and broader macro conditions. And the three major strategic developments that defined this year was Phillips 66 acquired full ownership of the WRB refining joint venture, so a 65% stake in its Germany and Austria retail business, and announced the acquisition of the Lindsey Oil refinery in the UK, all part of ongoing portfolio optimization toward higher return and integrated assets. The big takeaway is that Phillips 66 is transitioning to a cash return and efficiency model focused on refining margins, midstream growth, and cost control rather than volume growth. Now moving to my model, I want to start with where Phillips 66 actually stands today. In 2025, the company generated 132 billion in revenue, down from its peak in 2022. Net income was 4.4 billion for the full year, and operating margin came in approximately 2.6%, which reflects the thin margin nature of downstream refining. That said, the company generated 5.4 billion in free cash flow, which tells a much better story than the income statement alone. On the balance sheet, long-term debt stands around 18.7 billion with a net debt of roughly 18.6 billion. The company holds about 1.1 billion in cash, and importantly, they paid over 2 billion in debt in Q4 alone, signaling a clear commitment to deleveraging. Capex in 2025 was around 2.2 billion, or about 1.7% of revenue, which is a lean for a company of this size and reflects a shift away from aggressive capital spending toward returning cash to stakeholders. Diluted shares outstanding have declined from 473 million in 2022 to 408 million in 2025, showing consistent buyback activity over time. Overall, 2025 shows that this company is a company with tight margins, but strong cash generation, a manageable debt load it's actively reducing, and a clear capital allocation priority around shareholder returns over growth spending. Now moving on to my projections. On revenue, I'm modeling a negative 2% decline, 2% in 2026, reflecting continued margin normalization and the loss of revenue from divested businesses like Germany and Austria retail. But from 2027 onward, I project a return to growth at 3% in 2027 and 4% annually through 2030, driven by midstream scaling and stabilizing refining conditions. On operating margins, 2025 came in approximately 3%. I project a gradual expansion from 4% to all the way to 5% in 2030. This is grounded in two things: management stated $5.50 per barrel controllable cost target in refining, and the mix shift toward midstream, which carries structurally higher and more stable margins than refining. As those two tailwinds combine, the margin profile improves meaningfully over the forecast period. For evaluation, use a dividend discount model with a 4% risk rate at 4.3 equity risk premium and a beta of 0.87, giving a cost of equity at 7.71%, applying a 15x PE model to project earnings and discounting back my model yields an intrinsic value of 162.7 per share. At the current price of 155.75 per share, the stock is trading at roughly a 4% discount to the intrinsic value, making it a buy at current levels. And that estimate doesn't yet price in the Western Gateway pipeline or further widening in Canadian heavy crude differentials, both of which represents additional upside. In summary, Phillips 66 is a company in transition, moving from a commodity-driven downstream operator towards a more stable, return-focused infrastructure business. I believe the long-term thesis is sound, and I'll continue monitoring the midstream ramp and refining cost progress as key indicators. Thank you.